A. Demonstrate understanding of internal control risk and its management. Internal control risk is the possibility that a company's internal controls fail to prevent or detect material misstatements or operational inefficiencies. It arises from weaknesses in procedures, human error, system limitations, or management override. Effective risk management requires identifying vulnerable processes and assessing their likelihood and impact. Managing internal control risk involves implementing preventive and detective controls. Preventive controls reduce the chance of errors, while detective controls identify issues after occurrence. Regular monitoring, internal audits, and segregation of duties strengthen reliability. Continuous assessment improves effectiveness. Organizations must periodically evaluate and update controls to adapt to technological changes, regulatory requirements, and evolving business risks. B. Identify and describe internal control objectives. Safeguarding assets is a primary objective. Controls ensure that physical and financial resources are protected from theft, misuse, or loss through authorization procedures and physical safeguards. Ensuring reliable financial reporting is essential. Accurate and timely information supports informed decision-making and compliance with accounting standards. Promoting operational efficiency and legal compliance strengthens governance. Internal controls help ensure that activities align with policies, laws, and strategic objectives while minimizing waste and inefficiency. C. Explain how organizational factors influence the control environment. Organizational structure defines authority and responsibility. Clear reporting lines, defined roles, and proper segregation of duties enhance accountability and reduce risk of fraud or error. Policies, objectives, and goals shape behavioral expectations. Strong ethical standards and clearly communicated procedures support consistent control application across the organization. Management philosophy and leadership style are critical. A culture emphasizing integrity, transparency, and accountability strengthens the control environment, while aggressive risk-taking or tolerance of unethical behavior weakens it. D. Identify the board of directors' responsibilities. The board represents shareholder interests. Its primary duty is to oversee management and ensure the company operates in the best interest of shareholders, balancing risk and return considerations. Oversight includes strategic and financial monitoring. The board approves major policies, executive compensation, capital investments, and corporate strategy while ensuring financial reporting integrity. Independent judgment enhances governance. Through committees such as audit and compensation committees, the board provides objective oversight and reduces conflicts of interest between management and shareholders. E. Identify the hierarchy of corporate governance. Articles of incorporation establish the legal foundation. They define the company's purpose, structure, and shareholder rights, forming the highest governance authority. Bylaws provide operational rules. They outline procedures for electing directors, conducting meetings, and making corporate decisions. Policies and procedures guide daily operations. These detailed guidelines ensure consistency, compliance, and alignment with broader governance documents, supporting effective implementation of strategic objectives. F. Demonstrate understanding of corporate governance roles and decision-making procedures. Executive management executes strategy. The CEO leads operations and strategic implementation, while the CFO oversees financial reporting, risk management, and capital structure decisions. The board and audit committee provide oversight. The audit committee monitors financial reporting integrity, internal controls, and external audit relationships to ensure transparency and accountability. Stakeholders influence governance processes. Managers, employees, shareholders, and regulators each have defined rights and responsibilities. Corporate decisions follow formal approval procedures consistent with governance documents and regulatory requirements. G. Explain reasonable assurance and the objectives of internal controls. Internal controls provide reasonable, not absolute, assurance. Because of inherent limitations such as human error, cost-benefit constraints, and potential management override, no control system can eliminate all risk. Reasonable assurance means controls are designed to reduce risk to an acceptable level. Controls support operational effectiveness and efficiency. Procedures such as performance reviews, budgeting systems, and authorization protocols help ensure resources are used efficiently and objectives are achieved. Controls also ensure reliable reporting and legal compliance. Accurate financial records and adherence to laws and regulations protect stakeholders, reduce penalties, and enhance organizational credibility. H. Explain why personnel policies and procedures are integral to a control environment. Competent personnel strengthen control effectiveness. Hiring qualified employees and providing proper training ensure that individuals understand procedures and perform responsibilities accurately and ethically. Performance evaluation and accountability reinforce compliance. Clear job descriptions, regular performance reviews, and disciplinary procedures promote adherence to policies and discourage misconduct. Ethical standards and tone at the top shape behavior. Codes of conduct, whistleblower protections, and ethical leadership create a culture of integrity, reducing the likelihood of fraud and supporting a strong control environment. 1. Define and give examples of segregation of duties. Segregation of duties separates key responsibilities. It divides tasks among different individuals to reduce the risk of errors or fraud going undetected. No single employee should control all aspects of a transaction. Examples include separating cash handling and record keeping. One employee may receive payments, another records them in accounting records, and a third reconciles bank statements. This structure enhances detection and prevention. By creating independent checks, segregation reduces opportunities for misappropriation and increases the reliability of financial information. J. Explain why key functional responsibilities should be separated. Authorization of transactions must be independent. The person approving transactions should not also record or handle related assets, ensuring accountability and preventing unauthorized activities. Recording functions must remain separate from asset custody. Employees who maintain accounting records should not have physical access to assets, reducing risk of concealment of theft or errors. Periodic reconciliation provides independent verification. Comparing physical assets to recorded amounts identifies discrepancies promptly. Separating authorization, recording, custody, and reconciliation responsibilities strengthens internal control and reduces fraud risk.